the next one that we have here is equity. So let's head over to equity and also see if we can identify what equity is. We said that financial instruments are divided into three. We have financial assets, financial liabilities, and equity. Now, it is important to note that this equity here is different from what we call investment in equity. Investment in equity is a financial asset because you are saying that you have bought the shares of a company, meaning that if you sell those shares today, you will receive cash, right? Yeah. And because the shares that you have bought will make it possible for you to receive dividends from the company you bought it from, then it is an investment in equity, which is a financial asset. But the equity that we're talking about here is not the investment in equity. It is the opposite side of it. We said a financial instrument gives rise to a financial asset in one hand and a financial liability or equity instrument in another hand. So in this case, if you have an investment in equity, it means that the other person has equity itself. Yeah. So the investment in equity and the equity are the two legs. One is a financial asset, the other one is equity. Okay, so here it says equity is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. That's simple accounting. It says equity equals assets minus liabilities. So let's look at examples and see which one actually is equity and which one is not. Starting with issued share capital. Issued share capital simply means that the company has given out shares to the public, right? Good. So if the company has given out shares, the shares that the public is buying from the company, they are equity because they are residual interest in the company. I mean, if you want to, if the company goes into bankruptcy and declares that it's unable to pay its debts, when the liquidator is selling all the assets, there is a priority of payment by liquidators. The last person to be paid is equity. And for those that buy shares in a company, they are always the last to be paid. Equity is the residual interest in assets after deducting liabilities. So we say yes, issued share capital should be recognized as equity. So the next one that we have here is treasury shares. And treasury shares simply means that a company that has already issued shares, what they do is they buy back shares from some of their shareholders. So when a company buys back shares from their shareholders, they call it treasury shares. Now, treasury shares, according to IS 32, paragraph 33, they are often or always deducted from equity. So as a result of that, treasury shares are not categorized as equity, because if you look at it, I mean, number wise, we are saying that somebody made a purchase of issued share capital. Say for example, they paid $5,000. What would have happened is the company would have debited cash and credited equity, right, for the issued share capital. Now that the company is now buying back some of those shares, let's say the company is buying back $3,000 of shares. So, the accounting treatment would have been you credit cash for paying that person, then you debit your equity. You see? So when you debit your equity, invariably you are reducing your equity by the treasury shares. Equity represents your issued share capital, not your treasury shares. So our answer is what? You guessed right, no. Now the next one is retained earnings. Retained earnings is simply the profits that is retained that are not distributed to the shareholders at the end of the year. And so you notice that your retained earnings is also part of your equity because they invariably belong to your equity shareholders. And so retained earnings, yes, they are part of equity. Now the next one that we have here is share premium. Share premium simply means that your shareholders paid more than the value of the shares. So for example, you want to issue share capital and you discover that there is a high likelihood that people will actually pay higher than what your current share price is. So instead of $5 per share, you issue it at $8 per share. The $3 difference is the share premium, which also sits as part of your equity. And so what you have as share premium is also part of the equity because it's also the shareholder that own that. And we say yes, share premium is part of equity. The next one is other reserves. Other reserves comes in various forms. It could be as a result of the balances that you have in your other comprehensive income. It could be several items, but the major thing is that your other reserves are also part of the items that belong to your shareholders, and as a result it forms part of your equity. The next one we have here is authorized share capital. You see, authorized share capital, they are quite different a bit from issued share capital because authorized share capital is more nominal in nature. It's more like saying that, oh, when we registered our company, the authorities told us that we can issue 1 million number of shares, but we have only issued 500,000 shares. The 500,000 shares is your issued share capital, which represents your equity. The 1 million is not issued share capital. It is just what you have been authorized. So if you have issued 800,000, that's what will be your equity. If you have issued only 200,000 out of the 1 million, that will be your equity. Whatever balance that is left does not come into your books, and as a result of that, it doesn't form part of equity. And so our answer is what? No, authorized share capital is not equity. And the next one we have here is non-controlling interest. You see, when it comes to non-controlling interest, your non-controlling interest simply means your minority interest. So they are called the non-controlling because they don't have control over the entity. And this often comes in play in terms of a group structure. A group structure is whereby there is a parent and there is a subsidiary. And so when the parent does not have 100% ownership of a company, a parent and a non-controlling interest arises. But if a parent has 100% of another company, the company is a subsidiary and the company is wholly owned, then there will be no need for a non-controlling interest. But for example, in terms of numbers now, if we say that company A has 80% in company B and 20% belongs to company C, because company A and company C, they are not related, we will say that company C has a non-controlling interest while company A is the parent to the subsidiary, that is company B. And so non-controlling interest, they are more like liabilities when you look at it in terms of IS 32. But when you look at it in terms of IFRS 10, they form part of the equity portion of the financial position. But we are looking at it in terms of financial instruments, and we are saying that non-controlling interests, they are not part of shareholders fund. As a result of that, they are financial liabilities. So that's pretty much it. No is still the answer that we give, and that's pretty much it about the definitions and terms and items to understand when it comes to financial assets, financial liabilities, and equity. We have more things to do, and I'll see you in the next